session, we have two industry experts unpack the latest trends, challenges, and opportunities in hotel investments and management agreements. We have Mr. Kieran Bestall, Managing Director at Eris Private Equity Group. Kieran focuses on strategic growth of the hospitality real estate platform. He manages acquisitions, value enhancement, and realization activities. He is joined on stage by Ms. Lada Shelkovnikova, partner in hotels and hospitality at Watson, Farley, and Williams. Lada represents hotel owners, investors, and hotel operators in the executive negotiations, particularly of hotel management agreements, branded residences, franchises, mergers and acquisition deals, as well as sales and purchases of operating hotels. Please put your hands together for Kieran and Lada.
One. Can you hear me well? Thank you. All right. Welcome. Good to see you all. It's been, for me, 9 years that I come to this beautiful event. Congratulations to the Hotelivate team. 10 years is a major milestone. Let me say a few words before we begin about our rich professional history with Kieran. For those who may not know Kieran, he has been on the operator side for over 13 years, holding senior roles as brand development director, first at Alila, then with Hilton, and 3 years ago has transitioned to a more interesting space, which is private equity space, working first with Crescent Point Global, which is an equity firm out of Singapore, and then Crescent Point was acquired by Eris Global, which is a global player. And so Kieran's in overseeing Southeast Asia and Indonesia specifically as well, right? So our rich history lies in multiple HMA negotiations, opposite. So it was a very different dynamic, and then for the past 3 years we've been working together very closely. Yeah. So today's session is going to have two main chapters, HMA trends and hotel investments. And in between we'll be talking a bit about everything: franchise, asset management, debt financing, etc. I would like to start with a little overview of the market trends on HMAs, 5 minutes, and then we'll go into a cross-interview session. So across 27 countries that we work in, including in Indonesia, of course, we see that in the past 3 to 4 years after COVID, there are a few trends that have been solidified. And I will cover 3 today. First is that performance test is finally getting demystified. What I mean by that is that a lot of owners, especially experienced owners, if they cannot get a realistic performance test in a particular deal, they choose not to waste their time and effort negotiating that, instead focusing on the second best thing, the second best thing being termination on sale. If you are the owner who is having a strategy of build to sell, or like in Kieran's case, buy to sell, then obviously termination on sale is something that you would absolutely want to have in your HMA. Now, there are two very important points on termination on sale: is the termination fee and the moratorium period. The moratorium period basically means that if you sell the hotel during this period, you will not be able to terminate the contract with the operator. But if you sell after the moratorium period, then obviously that option is available to you, subject to payment of a termination fee. Again, termination on sale is never going to be for free. There is a potential brand damage, and obviously you have to compensate the operator for the loss of the project. Termination fee has to be realistic. Again, if it's disproportionately inflated, that it defeats the purpose of having the termination fee as such, right? It's just become unviable for either buyer or seller to pick up the check. It will kill the return on investment analysis altogether. So when we're talking about termination fee, there are two aspects of it. First is the term. how much of the term is yet to be in the HMA that basically the operator is dropping that term for you. And the second point is, what is the performance of the hotel immediately prior to termination? If the hotel operator was truly overperforming, and of course when you're on the operator side, you want to argue that, and it's a fair statement. If the operator was truly overperforming, termination fee has to reflect and reward the operator for it. And likewise, if the operator is underperforming, the termination fee has to have a discount, right? So that formula is something that is heavily negotiated between the parties. But my recommendation always to the owners when we represent them is, if it is something, a deal breaker for you, and I'm sure you'll be covering to which extent termination sale is important to you as part of the private equity fund structure. But if it's truly important to you, you want to bring that conversation up sooner, right? You don't want to waste 5-6 months of negotiation of term sheet and then bring it up later, and then the operator will say, well, this is something, a deal breaker for me. Thanks very much, Mr. Owner. We can't do this for you in this particular project. So just don't waste each other's time. Bring that up sooner if it is important to you. The second trend that I would mention is with regard to HMA disputes. We see a huge number of HMA disputes in the past 3-4 years. It's mostly actually owners being unhappy with operators, and there is a massive disconnect between owners' expectations and what they think is in the HMA, and when you actually open the HMA, they realize that they've agreed to it. So please do read your contracts carefully before you sign them. Yeah, it shouldn't be taken lightly. But on the operator side, we see that the main point of contention is always the working capital shortfall, where the owners just fails to pay the working capital when it is due. And then the second is FF&E and CapEx expenditures. FF&E and CapEx has always been one of the major stumbling blocks in all operations, because both of these expenses are below the GOP line, which means that none of these expenses by nature impact any of the operator's fees, and therefore the operator is not induced financially to manage these expenses efficiently. And therefore, inherent conflict of interest, there's nothing wrong about having a discussion of FF&E and CapEx implementation, but in the end of the day, we all have to remember that brand standards compliance is non-negotiable. So finding the way to implement that makes sense from your return investment analysis, that is an art that you have to work with your asset management team. The third final trend that I'll mention today is that there are a number of HMA flips to franchise, both in Asia and in the Middle East, especially among the experienced owners that have been there, done that, have had enough of sitting in the back seat and looking at their properties operations, and they chose to step in and run the operations themselves. Now, not everyone is a franchisee. It's not everyone's cup of tea, but not everyone is also eligible to become a franchisee. So either you need to have a strong in-house team that has operational capabilities, revenue management, asset management, sales and marketing, that is able to basically substitute the operator in this relationship. Or if you don't have in-house capabilities, you have to hire a white label operator who will be working for you, totally aligned with you, and will be fulfilling your instructions as the owner under the brand that you obtain in franchise. And on a number of occasions, we see that operators are very strongly pursuing the franchise path as well, and they're giving, on a number of occasions, substantial key money to sweeten the deal for the owners, to persuade them to go with the franchise arrangement. So these are the trends from me, and we'll now do the fireside finally. Sorry, I took 5 minutes. My first question to you, Kieran, given your extensive experience on both sides of the table, I want to understand now, knowing what you know and seeing what you've seen, from an owner's perspective, what are the 3 most important HMA points that you always negotiate?
Thanks, Lada. Is my mic working? Can everyone hear me? Yeah. Okay. I think on the ownership side, it's really critical, obviously, is your P&L, right? So fees is one of the most critical aspects of negotiating HMA and ensuring that you have the right fee structure that's suitable for your deal. And obviously, if you have repayments that need to be made, why shouldn't those be priority versus fees being paid to an owner or an operator in terms of an incentive fee? So I would say fee structure is very important to us. And as you just brought up, performance test is critical. But that can also go hand in hand with term. So if you have a lower term, maybe we don't negotiate so much the performance, like a termination on sale clause, because you have a shorter period on term, that is. Because by the time a performance test kicks in anyway, it's probably year 3 or 4 by the time they fail it. And if you have a shorter term, you can already exit. So to turn
shorter term, you
yeah,
mean?
in terms of tenure.
Yeah, I mean like 10 years?
10 years, yeah.
Good.
Try.
Okay. Yeah, try, okay.
Yeah, so is either that or termination on sale. That would be the option we'd really give.
Yeah.
So I would say fee structure, tenure, the performance test, and then we typically also do look at what kind of incentive they can give us in terms of key money and how much they'll put on the table as well.
Yeah. Well, obviously, because of your strategic value, it's
correct. Well, we're going to be doing a lot more hotels.
Yeah. Okay, then let me flip the question.
Sure.
What are the points in the HMA that you're just saying, you know what, I know I'm not going to get anywhere trying to negotiate those.
Yeah.
Let's not waste each other's time.
Yeah.
I'm accepting this risk.
Yep.
I'm just accepting the fact that, this is how the things work in the HMA setting, and there's no point of wasting your time.
Yeah, I mean, my biggest advice to people perhaps who haven't done it a lot is don't concentrate on brand standards, because it's just a battle you're not going to win. So we don't typically spend too much time on it. Also, the other huge area that an operator will definitely push back on is typically the centralized services. What I call the black box, or Pandora's box. You don't really want to open that. If you do, you might get lost quite a bit, but that's another area we typically wouldn't waste too much time on. And then there's other areas like assignment clauses, and actually one other area I find don't spend so much time is the whole, because it's so hypothetical, is damaging destruction clauses as well. I think people like to really get into the weeds of that when it's very hypothetical.
Yeah. Now let's cross the bridge when we get to
Correct, exactly.
All right, and so since we've touched base on the centralized charges, I have quite a few owners coming to us and asking to break down the various centralized services charges, because they're obviously, as you said, a Pandora box that is very hard to open. And in fact, my advice always is to go to asset managers and seek them to give you an understanding of what are those charges, so they can guide you through the base, when is it paid. So is there a time where you would scrutinize any of the centralized services charges, if at all? You won't negotiate them, but will you scrutinize whether they are compulsory versus optional? And as part of that discussion, would you ever scrutinize the loyalty program redemption fee?
Okay, so I think the only area which we've had, or I've had success discussing, is what category does your hotel sit within a redemption? Because obviously, depending on your brand and where it fits within segmentation, the operator is going to assign your hotel to, like, let's say there's 10 categories, to a 5 or a 6 or a 7, and then that depends on how much money you get back from your ADR. So the only area we've been able to really drive, I would say, value in that respect is maybe getting more alignment in that regard. Where do we see our value fairly put? Because obviously, if you're put in the lease category, you're going to be getting less than ADR. So the objective, obviously, is to get as high ADR, pushed back into the hotel as possible. So we have seen a little bit of success in that area. In terms of centralized services, I think, it kind of goes back to your first question. One of the most other important things to us is budget approval, right? Understanding, your P&L, what you can and cannot, approve, and centralized services is one of these items that, kind of just get put there. So I think understanding I think for us it'd be more the clustering aspect and how much is distributed through the centralized services versus an overall clustering budget. So that's another area I think we've been pushing to get more clarity on.
Yeah. Very important to understand, right? Because that obviously goes back to your return investment analysis. If you don't do your numbers right, you may find yourself in a position where it just doesn't make sense for you, right? And you already signed the contract, so you really can't get out of it.
Absolutely.
If if we're talking about, going forward, because we're here, all of us here, we're all creating trends. And as a market, as a force, we're all here to change things if we believe they are unfair.
Yeah.
If you were to look at relationship of hotel owners and brand owners, I wouldn't say specifically operators, because I also want to look at franchise as well. If we're talking about brand owners and hotel owners, what is the trend that you want to see solidifying in the next few years, or maybe a long-term perspective, whatever it is?
Yeah, I mean, I think the problem we've got into is become a rat race, right? So everyone's just trying to build their brands and grow. So they sign another deal and it just kind of disappears within the ecosystem. So I think going forward, a little bit more skin in the game to have alignment, so you don't just sign a contract and then run away from it. So I think the ability that, as an owner, we're the ones, building the brand on behalf to an extent, right? We're the ones putting the capital in, we're the ones who are putting the capex into these hotels to drive their brand. So I do believe, the operators should be a little bit more open to skin in the game. And I think going back to our previous conversation just now, transparency. I mean, I think there's still a big lack of transparency when it comes in terms of, the whole clustering and the whole, and by the time it's too late. People have been hired, people's lives are at risk, people have families, and at that point, like, what are you gonna do? You're gonna go fire those people because you didn't get approval on that? So I think it's transparency and skin in the game.
So we're talking about, again, centralized service charges, transparency, bonuses and benefits to employees that, again, not every operator is being transparent.
Well, and also sometimes it's two contracts, right? A general manager has a contract with the operator, and then they have a contract with us as an owner. So it's alignment on that, and it's just being transparent, understanding, what are the true goals and KPIs of that.
And alignment of KPIs of general managers as well,
exactly.
Which is another issue.
There could be a double incentive, right? Or a different incentive. So again, going back to transparency is I think one of the things as an industry or as an operator we need to improve on.
Well, again, negotiating the HMAs to make sure that transparency is contractually obligated. Okay, let's move to hotel investments. We're moving good by the time. Hotel investments, generally speaking, in the past few years, during COVID and after COVID, there was a major operation cost pressure, plus the development cost increased significantly, which led to a number of renovations and new hotel developments being stalled or put on pause for an indefinite period of time. On the other hand, the recent 6 months of US-induced unnecessary tariff saga created a lot of inflationary concerns, and especially in Asia, because most countries here are export-driven economies. As a result, a decrease in export obviously creates the decrease in discretionary spending on leisure, and likewise, business tourism is under review, right? And a lot of budgets are tightening up because of overall inflationary impact on economies across all industries. So as a result, when we speak to owners and operators, we see that the sentiment, the financial projections for 2026 are rather conservative, if I may put it that way. So it's basically wait and see kind of strategy. And so on top of this, if we're looking at the availability of debt and the cost of debt, which has been increasing during COVID and post-COVID, and a lot of banks have dropped out of hotel investment mandates, that obviously creates the hotel investment story for a lot of buyers who are non-cash buyers quite challenging and tricky, to say the least. So now we're looking at private equity funds, which obviously have better access to funding and better equity availability for all of these deals, and some flexibility there. So question to you, Kieran, based on the existing landscape, according to you, according to Aris, is this a good time to buy?
Yeah, I mean, I think we had COVID, right, where we call like a deep value opportunity to buy, right, where people were super distressed and maybe, hotels were closed, and especially in Southeast Asia where hotels are owned by individuals, they were like, you know what, I don't really want to do this business. I think there was a lot of opportunity, but that's kind of now shifted. As you said, you brought up tariffs and various other macro environments, which is making things challenging. People have stress in other businesses, right? So we definitely and certainly still see the opportunity to buy hotels in the region. But I think going back to your point on interest rates, there's still, when this high interest rate environment, the bid to ask is still a large spread, which is a problem, right? So when interest rates go lower, it's easier to do deals. So I think the biggest issue we still face is, entry price, like we're cash flow buyers, right? So entry price on cap rate versus what the interest rate is still a little bit of a challenge.
Yeah.
But I do definitely still believe, our pipeline's good, it's strong. We're still acquiring at this point in time.
Yeah. You have to be creative with that.
Oh, absolutely.
Yeah. What about Indonesia? Do you see discounting on hotel assets here? And if so, which segments where?
Yeah, I mean, actually, it's a reverse. So Indonesia typically has always had a pretty high interest rate environment. For the last couple of years, they've been floating around 8%, which is pretty attractive for previous regimes. I mean, it's in today's world, it's actually quite on par. So Indonesia, if you look at Jakarta, it's a heavily dominant market on commodities. So if commodities are doing well, the market's doing well. Indonesia, since COVID, the borders have opened. Bali's done extremely well. So we would have loved to do more deals and would have loved to done something in Bali, but the hotels are doing well. So it's a little bit of a challenge.
Damn it.
Yeah, exactly.
As part of your overall philosophy, and we can focus on Southeast Asia outside of Singapore, because Singapore is a bit different market. As part of your philosophy, do you focus on value-add opportunities only, or are you looking at core and core plus, or the mix of all of these?
Yeah, that's a good question. So the fund we've currently raised for, it was to LPs that wanted more of a high-risk, high-return situation. So every deal we look at and every deal we've acquired so far has been PE return like. So we're talking 25% north IRRs, so about 2.5 times equity on a deal. So it's definitely value add. So it's repositioning, capex, business fixes. I think down the line with Ares coming into play, we'll be able to recycle some of these LPs out, and we'll probably get a more blended portfolio where we look at a little bit more core plus plus, and you balance out the portfolio. So you have your higher return stuff, you balance that in with 12% returns, and then you have a little bit of yield buying there too, and then you have a nice balanced portfolio.
Yeah.
But for the time being, in terms of where we're at, it's still very much so value add opportunities that we look at.
Okay, and if you're looking at Indonesia, obviously we're very interested to hear more about your plans here. When you look at Indonesia, what does an unmissable deal look like for Ares? Which deal you would definitely go with? Which segments where, obviously Bali you mentioned, but which segments?
The first thing, the one thing I would wish for in this market is a clean land title. I find the more you peel back the onion here, the more you cry. In terms of due diligence and land titles, you could be in situations where you have like a Hak Milik, which is an individual title, and then you have a Hagibi, which is a company title, and then someone's leased that out, and then the bank can and then someone's actually mortgaged out his site, and then the whole thing's gone, right? So I think clean titles would be the first step of a perfect deal for us in this market. And then for us, I mean, we look at international airlift, right? So Bali for us would be the market we would concentrate on for Indonesia, beachfront, cliffront, resort where you could really drive, high ADRs and NOIs into those hotels.
And is it luxury or mid-scale, or what is it?
So as an investment thesis for us anyway, we only do look at 5-star because, the amount of work it takes to do a 400-room hotel is the same amount of work as it does to do a budget hotel at 80 keys, right? So, do we concentrate on something that can make us $10 million of net operating income, or something that makes us, $250,000 of net operating income? So typically for us and our investment strategy, it takes the same amount of time. It doesn't matter. So we typically only do luxury or upper upscale. It's the best use of our time, and it's the area where we think even during economic downturns, even though there's macro environments, we can still, the luxury traveler still travels. They still spend money. So it is the segment we look at.
Other than Bali, where else?
We've looked at a couple of things in Jakarta.
Yeah.
Jakarta, again, as I mentioned before, it depends on the current economic environment. But Jakarta, for us, it would be very important to, again, it'd probably be in the 5-star space, but with a really good ballroom and good location, because that would drive, probably 45% of your total revenue.
Yeah. So speaking of title, and I remember we had this discussion at HiCap last year before?
Probably.
Obviously, because of the relatively short tenure of HDB title, 30-20-30, does it make sense?
So you're talking about Huggy B title? Yeah, I mean, Huggy B, you just have to go down to the office and get the stamp. So it's kind of a perpetual lease in effect. So for sure, but we don't like if it's a 30-year lease and that's it, and without renewals, because we hypothetically we're cash flow buyers, right? So if someone had a 30-year lease, they sold it after 5, we buy it, we hold it for 5. There's 20 years left. Someone's going to discount cash flow to 0 for us. So I would never buy something or be in a position where I'm buying something where there's no tenure. So tenure for us as a fund is incredibly important, and so obviously freehold's obviously always the go-to if possible. If it's a lease, it needs to be a long lease. It needs to be like over 50 years plus with a right to renew.
And that's why I asked, because here obviously it's not guaranteed, so you still have to go through
the process. But it's still more aligned. Like it's not like
you
Thailand
that
where
risk.
it's 30 and then the landlord doesn't need to renew.
So you underwrite that risk.
Correct, exactly.
Overall country
exactly.
risk.
Exactly.
Is there? We have 1 minute left. Do you want to ask me something? Free legal advice.
I would have to pull out my phone. I didn't think I had time to ask you something, but now I'm going to. Okay, I'll do this one. What legal opportunities and risks should you consider in cross-border capital flows in Southeast Asia?
Okay, cross-border capital flow in Southeast Asia in hotel space. And this is what you've been covering as well, a little bit about Indonesia. There are risks attached to Southeast Asia as a region. First is the examples where title deed is still in a paper form. It's not electronic. Sometimes you have to go through like physically chambers of paper to understand who actually owns the land, and
or the certificate gets lost.
Or the certificate is lost, or there are multiple duplicates, and this is one thing. The other thing is that in most cases there's absence of a centralized, comprehensive database of court cases. Means that you cannot with 100% certainty say that this land is clean and this target is clean. Right? So that's why you always have to induce disclosures through warranties of the seller and take the risk that it might not be true. Right? So this is the second point. Independently checking the title is really, really tough. The third thing is, in most cases, you cannot, unlike in Maldives, where you can go to the government and obtain an official response to your due diligence request. In most cases in Southeast Asia, you can't do that. You can't go to the land authorities, submit a paper with whatever questions you want to ask and due diligence questions, and they just won't respond, or they at best respond unofficially, right? And that's not good enough for the global players, of the likes of Ares and Blackstone, etc. So it's a lot of jurisdictional risk that has to be absorbed. Now, having said that, because of this higher risk, there's obviously an opportunity of the higher return. Now, you can play with other tools that you have available. So first things first, always induce disclosure through warranties, right? Warranties list is probably the most important thing you need to negotiate in cross-border buys and sells if it's not your home country where you're investing, right? The second point is going through comfort letters. So if the property is managed by an operator, go to an operator and request for a comfort letter. Ask the operator, are there any breaches on the owner's side? Tell me what are those. I need to underwrite the risk. I need to know what I'm stepping into because I'm assuming all the...
We had a situation like that.
Yes, we had a situation like that. So basically tell me what is there that my seller is not telling me. The third point is you can procure what's called W9 insurance, warranty and indemnity insurance. It's a fantastic tool that allows both parties to sleep peacefully at night, because once you close the deal, once you acquire the asset, it's just the beginning of the story. You will start uncovering all the things that might have gone wrong in your operations. So that's why there is a tail liability period. Sometimes it's 3 years, sometimes it's 5 years, sometimes it's 7 years, maybe longer, in which the buyer can still claim from the seller for various breaches of contracts and breach of warranties. So that insurance, it's a product, you can buy it. That insurance allows the buyer, instead of going to the seller and claim from the seller. And the seller might have been already gone and, live somewhere in Caribbean, and good luck suing them. But it allows the buyer to have a peace of mind and to go against the insurance and claim whatever expenses they've incurred as part of that insurance coverage, which is, especially with global players, is a very, it becomes a norm in hotel investment deals on a big scale. And finally, if you can run independent due diligence requests with authorities, if you can, please do that. It's never, you can never be too cautious. As a buyer, you would always want to ask the government, even if the government remains silent, but at least you tried. And if you get a response, sometimes you will be surprised what are the issues that can be uncovered. On a number of occasions, and we've been there, that the government can raise certain claims that even the seller didn't know about. So hence, you would want to know them as a buyer before they hit you.
Who should pay for the insurance?
Yeah. Who should pay for the insurance? Good question. If I'm selling an iconic asset, and if I have buyers standing in line, then the buyer's paying for the insurance, and that happened. But if I don't have a line of buyers waiting for an opportunity to buy my asset, then most likely I want, at least as a seller, I want at least share the expense, and that's when the discussion, what's the proportion, 50-50 or any other proportion you want to share it, yeah. Thank you for your question. I think we're out of time. I hope you loved it. Thank you so much for listening. Thank you for your time.
Yeah.